Hey everyone, thanks for joining us today for the Unicorns Trends webinar. We're going to give everyone just another minute or two to join and then we'll get started. Thanks. Okay everyone, thanks for waiting. My name is Riley from CB Insights and I'll be walking you through a few housekeeping items before turning it over to William for the presentation. First, don't worry about taking notes as we'll be sending both the slides and the recording to you right after the webinar. Second, if you have any technical difficulties during the webinar, your best bet is to reach out to the Citrix Help Desk. You can also tweet at us or send an email to webinar@cbinsights.com and we'll do our best to help. But again, we'll send everything out afterwards, so don't worry too much. Okay, so as with all of our webinars, we'll be moving through a lot of data and insights and doing it pretty quickly. But we also want to make sure that we're answering your questions and keeping this relevant. So throughout the webinar, feel free to ask us questions using the questions tab within GoToWebinar or via Twitter using the hashtag CBI_unicorns. So a little bit on CB Insights. We're a data science and machine learning organization backed by Pilot Growth Equity and the National Science Foundation. We track every private company in the world and all the investment and financing activity related to them to help our clients answer questions about major trends, competitor strategy, potential disruptors, and much more. Here you can see a few of our happy customers. Now a little bit on William. William is a tech industry analyst here at CB Insights with a focus on cybersecurity and unicorns. Before CB Insights, he worked in the Middle East and North Africa, where he conducted research on entrepreneurship at the WAMDA Research Lab. William has a degree from Denison University and a master's degree from the Middlebury Institute of International Studies at Monterey. I'm going to hand it off to him for the presentation.
Great, thanks for the introduction, Riley. So, we'll be covering unicorn companies today. These are private companies that are worth $1 billion or more. And I'll draw your attention here to a quote by Stuart Butterfield. He's the CEO of Slack Technologies, which is a unicorn that we'll discuss today in the webinar. Basically, what Stuart's saying here is that this designation of unicorn is arbitrary because it's really just a paper valuation. We really need a liquidity event to really see how accurate that valuation is. But it's still significant because, like he says, this is the threshold for potential customers, employees, and the press to really take notice of these companies. So those are the companies we're going to look at today. And before we dive in, I'll give you a little overview of where we're going. So we're going to start out by taking a look at the current Global Unicorn Club. We're going to look at it, on a geographic basis. We're going to look at the different market segments that are involved. We're also going to look at some of the most active investors in the current club. We're going to stock the smart money investing in the club. I'll explain what that means later. We're also going to look at historical unicorn trends. This means we're going to look at how this cohort of companies known as unicorns fares in the private markets over time. And then we'll conclude with some trends to watch regarding these companies. So Right here you can see that as of February 1st, there's 185 private companies in the world that are valued at $1 billion plus. And the largest share of those unicorns are in e-commerce, or they operate an online marketplace. The next most populated segment is internet software and services, and that's followed by fintech. So if we look at that on a geographic basis, we can see that there's 24 countries around the world right now that boast at least one company worth $1 billion or more. Actually, the United States is home to over half that club. Around 52% of the companies are based in the US. China comes in second. It takes roughly a quarter of the club. That's followed by India, the UK, Germany, and South Korea, respectively. No other country on earth has three or more unicorns. So because the US takes such an outsized share of the Unicorn Club, we decided to zoom in on exactly what's happening in the US when it comes to billion-dollar companies. As you can see, there are 11 US states with at least one company valued at $1 billion or more. California takes the most of that share, followed by New York, Massachusetts, Illinois, and Utah comes in fourth, and Florida comes in fifth. Also interesting is that if we look at the top five most well-funded unicorns in the US, we can see that Uber comes in first. It's followed by Airbnb, Infor, Snap, the parent company of Snapchat, and Palantir Technologies. Interestingly, Infor is actually the only unicorn out of the top five that's based outside California, and that's located in New York. So here we can see a selection of US unicorns, and we can see the time it took them to reach their billion-dollar plus valuation from their first equity financing. Now, again, I'll just reiterate, this is not from the date that the company was founded, but rather from the date that they received their first equity financing. So really the big takeaway here is that some companies can do this very quickly. As you can see here, Magic Leap and Snapchat did it in under 2 years. Magic Leap actually did it in under a year, which is interesting because the company, despite being worth more than $1 billion, has yet to actually release a commercially viable product. It does have a significant number of patents that CB Insights tracks, which suggests that the company has some valuable proprietary technology that it's holding on to. Now, zooming back out into the global unicorn club, we can see here that it's getting increasingly crowded. And what we mean by that is that, obviously some companies drop off this list as they exit or as their valuation drops below $1 billion. However, in recent years, this club has actually gotten increasingly crowded. In 2017 already, we've seen 3 unicorns added to the club. That's the companies Zhihu, Zoom Communications, and another company, UR Work. And we'll talk about those 3 companies a little bit later. So collectively, this club of companies is worth $633 billion, and the companies have all raised a combined total funding of $126 billion. And if we look here at something called the power law of unicorn valuations, what this is essentially saying is that when you look at the valuation spread amongst these companies, it's pretty top heavy. That is, that the top 15 unicorns, and these are called decacorns, these are companies that are worth $10 billion or more, they take 51% of the collective value of this club. The next 170 unicorns, which are worth $325 billion, take 49% of the collective value of the global unicorn club. Interestingly, the top 5 unicorns by valuation account for 30% of the value. Now, we can do the same thing here and look at the funding that these companies have raised. Now, it's not quite as top heavy as the top 11 unicorns. These are the unicorns that have all raised over $2 billion in funding. They account for 37% of the combined funding of the club, and the next 170 unicorns, which are worth 72 or which have raised $72 billion, account for 49% of the collective funding. Now here we can see the top 5 most highly valued unicorn companies. Uber is the most highly valued private company in the world at $68 billion. It's followed by Xiaomi, Didi Chuxing, Airbnb, and Palantir Technologies. There are actually no unicorn companies outside or inside this top 6 list here that are not from the US or China. And also, interestingly, we haven't actually seen a top 6 most highly valued unicorn emerge in the last 2 years. 3 out of 6 of these companies emerged in 2011. Here we can see the most well-funded private unicorns. Again, Uber is on top, and actually the only companies to appear in the most highly valued and most well-funded lists are Uber, Didi, Airbnb, and Xiaomi. Collectively, there's 2,800 different investors that have a stake in a company in the Global Unicorn Club. And if we break that down, we can see that the largest share of those investors are venture capitalists, and this is followed by corporations and their corporate venture arms, angel investors, and then asset and investment managers. And no other group accounts for more than 5%. So if we look at the total, uh, spread of investors in the Unicorn Club and we rank those investors by the number of portfolio companies that are unicorns that they have, we can see here, that it's quite diverse. Groups like Fidelity Investments and Wellington Management are not venture capitalists; they're asset and investment managers. DST Global is a corporate venture arm, and then we also have, your traditional VCs, Andreessen Horowitz, Kleiner Perkins, Caulfield Byers, Sequoia, and then there's SV Angel also in there. And as you can see, SV Angel, Sequoia, and Tiger Global all tie for first. Now, we can look at that same list of investors and we can look at, where they're getting into these deals. Are they getting into them at an early stage? And this is important because typically, early stage investors will see a higher multiple of return in the event that there is an exit of one of those companies. So you can see here that over half of SV Angel's unicorn portfolio was invested at the early stage. And you can see that nearly half of Sequoia's was invested at the early stage. On the flip side, Fidelity, DST Global, they're not investing at the early stage. These are late stage investors. So here we can actually see the rank of investors in the Global Unicorn Club by their early stage investments. And SV Angel takes the first spot with 16. It's followed by Sequoia Capital at 10. Interestingly, Y Combinator, which only invests at the early stage, has 7 unicorns in its portfolio. Now we're going to stalk some of the smart money investors. And what are smart money investors? This is a group of investors that CB Insights declares smart money based on the performance of their portfolio companies, as well as the performance of the companies in their portfolio that have exited, the exit performance of those companies, rather. So here, when we just look at smart money investors, we can see Sequoia Capital is on top, Andreessen Horowitz is in second, and Kleiner Perkins rounds out the top 3. So those are some familiar names. We just saw them amongst the total most active investors in the unicorn space, but then we also have some new names on this list because we're just looking at smart money. Interestingly, of Sequoia's unicorn bets, it's participated in more follow-on rounds to the fintech company Stripe than any other unicorn. Also interesting is that Andreessen Horowitz has the most cybersecurity unicorns in its portfolio amongst the smart money VCs. Those companies include Okta, Illumio, Tanium, and Lookout. So here we can use CB Insight's business social graph tool to visualize the co-investments between the top 3 most active smart money investors. And as you can see here that all 3 of these firms have co-invested in the unicorns Instacart, Airbnb, and Jawbone. Now we're going to look at historical trends. And essentially the question that we're seeking to answer here is how does this cohort of companies known as unicorns fare in the private markets over time? Now, a critical note on methodology here. What we're seeing here are dollars and deals that have gone to unicorn companies even past unicorn companies while they were a part of the club. So for example, a company who raises a round that then values it at $1 billion, that round is included It has some other rounds, those rounds are included, and then it sees either a down valuation and it drops out of the club. No subsequent rounds are included. The same thing is said if a company has an exit. Post exit, it drops off the unicorn club. It's no longer included in this analysis. And then obviously, all the current unicorns and their funding history is included here. So, what this allows us to see here is that the propensity to invest in unicorn companies actually peaked in 2015 and since dropped off last year. And if we break that down on a quarterly basis, we can actually see that the third quarter of 2015 was the most active for dollars and deals. We saw some billion-dollar deals in Q3 15. We saw Didi Chuxing raise a $2 billion Series F, and we also saw $1 billion deals go to Uber and social finance, known as SoFi. Six unicorns have actually received funding in 2017. We've got the three new unicorns, Zoom, Zhihu, and URWork. And then we've got some older unicorns that have gotten funding this year as well, InsideSales.com, HomeLink, and Funding Circle. Now here we can see the time to $1 billion valuation for US VC-backed companies from the date of their first equity financing. Again, this is not the date the company was founded, but the time between that first equity funding and the date at which they achieved their $1 billion valuation. So Uptake Technologies, predictive business and analytics startup, is actually the fastest, and followed by Magic Leap, and they're the only two to actually do this in under a year, but all 11 of these companies have done this in under 2 years. Now, it's also important to note that what we're looking at here are companies that were unicorns and companies that are current unicorns. So, for example, Jet.com, you can see there in fourth place. Was acquired by Walmart, and so it's no longer a unicorn, but it took 463 days for that company to become a unicorn from when it raised its first round. Similarly, Square has IPO'd, and we'll talk about those exits later. Now, we're going to look at what's called crossover participation. And this is a group of investors that typically have more diversified portfolios in both public and private markets. So we're looking at asset and investment managers, hedge funds, mutual funds, investment banks, even sovereign wealth funds. So as you can see here, the funding activity of these investors mirrors the overall activity in the space, and that 2015 was the most active. And specifically, Q3 15 saw some billion-dollar deals with crossover participation, and those deals went to Didi Chuxing, Uber, and SoFi. 2017 has already seen two unicorn financings with crossover participation. That was URWork, which raised $58 million in a Series B, and Funding Circle, which raised $100 million in a Series F round with crossover participation. So here we can see the most active crossover investors investing in unicorns since 2012. So we can see Fidelity Investments is on top, Wellington Management comes in second, and rounding out the top three is Goldman Sachs. Now we'll look at corporate participation. These are corporations and their corporate venture arms and their investment activity into unicorns. Again, over time, we're looking at the historic deals of this club. So again, 2015, the most active. Specifically, Q3 15, we saw some billion-dollar deals to Didi, Uber, and SoFi. And 2017 has been relatively active, despite the fact that the year just started. Corporate participation in unicorn deals has gone to Zoom, the new unicorn, Zhihu, another new unicorn, also HomeLink, URWork, a new unicorn, and InsideSales.com. Those companies have raised rounds this year with corporate participation in those rounds. Here we can see the most active corporate investors that are investing in unicorns, and Chinese companies take the top two spots, Tencent Holdings and Alibaba Group. And interestingly, Google takes the third and fourth spots. You see Google Ventures there in third, and Capital G, the company's late stage growth equity arm there. And then rounding out the top six are Salesforce Ventures and Comcast Ventures, respectively. So next up, we're going to take a look here at some select corporate acquisitions of unicorns, some of the more recent and notable deals. We saw AppDynamics get acquired by Cisco Systems early this year. That deal was for $3.7 billion, and that's significant, and we'll take a closer look at that in the next slide. But also note that this year, Hewlett Packard Enterprise also acquired the unicorn SimpliVity. Interestingly, they acquired it for $650 million. So SimpliVity was last valued in the private markets at $1.1 billion. So that's a significant down exit for the company. Also, last year, Cisco Systems acquired Jasper Technologies. So again, we're going to take a look at this AppDynamics acquisition by Cisco here. And what we can see is that AppDynamics was last valued at $1.8 billion when it raised $158 million Series F round. And then, this acquisition for 3.7 billion is actually almost double that last private market valuation. It's a 97% increase. Also interesting is that it took 10 years for AppDynamics to go from being worth $12 million in the private markets to exiting for close to 4 billion. So now let's take a closer look at exit trends, right? We're going to look at the M&A and IPO history of unicorn companies since 2012 to 2017. And so what we can see here is that there's 31 IPOs and 24 M&As over the time period. Probably the most interesting takeaway right here is that you can see the number of IPOs, especially since 2014 through 2016, has actually gone down. And this is a trend that we're going to address a little bit later, but keep in mind that companies, especially larger late stage private companies, are staying private longer. And that means that the IPO market has, largely dried up for these companies, though that could change soon. Again, we'll talk about that in a little bit. The top 3 IPOs of all time were Alibaba Group in 2014, Facebook in 2012, and JD.com also in 2014. So here we can see actually the mergers and acquisitions timeline for unicorns, since November 2013. And actually, it's interesting that M&A and activity is rising, and this is evidenced by the fact that 63% of the M&As since 2013 have actually occurred in the last year since 2016. Your top M&As include WhatsApp, Stemcentrx, and Uber China. Again, like we mentioned, SimpliVity and AppDynamics were each acquired this year. So another company that's reportedly supposed to IPO this year as early as March is Snap, the parent company of Snapchat. And we're using here the mid-range estimate for its reported early 2017 IPO. And Snap was last valued in the private markets at $18 billion, just behind Uber, Airbnb, Palantir, and above WeWork. If Snapchat does IPO in March, and if no other company IPOs before that, it would be the first in 2017, and it would be the first since Meitu went public in December 2016, when that company was valued at close to $5 billion. So what we're doing here is we're going to look a little bit closer at Snapchat compared to some other social media giants. What we're seeing here is a price per user metric that's based on a ratio of the company's valuation compared to the number of its monthly active users. So for the public companies in this chart, we've got Facebook, Twitter, and Line. We used the company's market cap as of November 2016 and divided that number by their respective number of monthly active users. So for the companies that have been acquired, such as WhatsApp and Instagram, we used their valuation at the date of exit and divided that number by the number of users at exit. And valuations for companies here that are still private, such as Snap or Hike, were determined based on the latest funding round and the current number of users. And again, Snap's valuation in this analysis is the mid-range estimate for its reported early 2017 IPO, and that's at 22.5 billion. So how does Snap stack up against other social media companies, both in the public and private markets? Well, estimating a valuation per user is difficult, mainly because Snap has yet to publicly release its monthly user numbers, though it said it could release more financial information publicly very soon. However, along with financials, these numbers have leaked in the media from time to time. So we can estimate a very conservative 225 million monthly users for Snap at the time of its IPO in March 2017. That would be roughly the same number that Twitter had at the time of its IPO. And these numbers would give Snap a price per user multiple of 100x. That makes Snap less richly valued on this scale than Pinterest, which is a fellow unicorn that's been a little slower to monetize and create advertising units, and has also grown its users more slowly than Snap. Also, investors in this case may be betting on the future growth of Pinterest, so it still means that Snap is cheaper on this basis than Pinterest. That would also make Snap roughly twice as valuable as Twitter at present. Also, interestingly, in February 2014, the Japanese e-commerce site Rakuten was acquired by the messaging app Viber for $900 million, dollars, and that put a 9x multiple on the company's 100 million users. That means Snap is actually 10 times as expensive as Viber on this measure, but again, it's easy to find justifications for this premium for Snap, as Viber is much smaller and has more of a messaging function, which is more difficult to monetize, and the video sharing service and broadcasting that Snap boasts is also a plus. Unsurprisingly, Facebook dominates. This chart really shows how impressed investors are with Facebook's ability to create mobile ad units and grow even at its tremendous scale. So, Snap has been growing daily active users at 50% annually based on some of these leaked numbers, and reportedly it had 150 million daily active users in June 2016. So, given that, Snap's monthly users could actually be higher than the 300 million by the time of its IPO, in which case it would be considerably less expensive than what's indicated in this chart. Now here, zooming out from Snap, we can actually see the top VC-backed unicorns exits by valuation. We can see here that Alibaba takes the top spot when it IPO'd in 2014 for nearly 170 billion. Three of these six companies exited with an IPO in 2014. There's actually only one acquisition amongst these six, and that was WhatsApp, which was acquired by Facebook in 2014. Here we can see the most well-funded VC-backed unicorns before they exited. So we can see JD.com takes this top spot. Actually, 70% of the companies on this list are US companies, and only 3 are Chinese: JD.com, Dianping, and the UCAR Group. Now, we'll wrap up here with some unicorn trends to keep an eye on, some things to watch out for. Again, these are the 3 newest unicorns in the club. 2 Chinese companies. We see Zhihu and URWork. Zhihu is a Q&A website similar to Quora. URWork is a co-working space. And Zoom, a US company, is a cloud-based enterprise video conferencing platform. Now, keep in mind that we mentioned earlier the funding environment for these companies is tightening up. So we may actually see the valuations for new unicorns be closer to that billion-dollar mark rather than these stratospheric valuations that we've seen in years past, though time will tell. Another trend to look out for is that not all of the current unicorns are doing well. So these are companies that are still valued at $1 billion that have experienced a down round. That means that they raised a round of funding in which the company was valued at lower than its previous valuation. So for example, the Global Fashion Group raised a down round last year, a significant one that saw the company's valuation slashed by almost $2.3 billion. Jawbone, since 2014, has raised a series of down rounds. And then this year, the company Langia, which is also known as HomeLink, raised a down round when it was down about $500 million. So 2 trends to kind of tease out here. One, we mentioned earlier that the valuations for these companies in years past, particularly in 2015, were pretty stratospheric. And maybe these companies, as they, struggle to achieve profitability, these valuations are going to come down a little bit. Similarly, in the case of Langia, what we might be seeing here is a company that was valued really high, and as the funding environment tightens up and it needs to continue to raise more money to grow, it's going to see that valuation lowered so that investors can receive some more favorable terms on the deal. Another trend to note here is that some unicorns really just fail outright. Three cases here. We saw Mode Media shut down in 2016 after it couldn't get new investors and nobody wanted to acquire the company. Fisker Automotive, which actually make luxury hybrid vehicles, filed for bankruptcy and then was sold to Wanxing Holdings in 2014. If you want an interesting story about unicorns and how hard it is to sometimes create a company in this space, type in Fisker Automotive, Tesla Automotive history, and read about the linkage between those two companies. It's pretty interesting. Next, you can see Powa Technologies, a payment startup, filed for bankruptcy, and its assets were sold off to a group of investors. So that being said, let's move on to our final trend here. And this is probably the biggest trend that we've witnessed in the Global Unicorn Club over time, and especially recently. It's that these larger late stage private companies, and these are typically your decacorns valued at 10 billion or in some cases even $20 billion or more, are raising larger billion-dollar plus rounds, namely from institutional investors like banks and in some cases sovereign wealth funds. So I'll draw your attention here to Uber, which raised a $3.5 billion private equity round from the Public Investment Fund of Saudi Arabia in 2016. It's one of the largest tech financing rounds in history. So again, Diddy has raised $2.8 billion round, among others, and Airbnb has also raised a couple $1 billion plus rounds. Now, what are we looking for going forward? Well, I can tell you that the IPO chatter is up. As we saw in that slide on exits, IPOs were down in 2016 for the unicorn companies. But as Snap looks forward to IPOing in what could be as early as March, like we said, investors are hoping that this opens the floodgates for unicorn companies to go public. Um, you know, what we're seeing here is a case in which these private companies that can raise these larger rounds can still get funding, but they can't necessarily get all the liquidity they need to cash out their employees and early investors. So it's very possible that we might still see them IPO. If that's interesting to you, I'll draw your attention to the CB Insights Tech IPO Pipeline report that we just released. And we profile some of the unicorn companies that are most likely to go public in 2017. Just a few of those companies are Pluralsight, Okta, Blue Apron, and Qualtrics. But again, that report's available for free if you want to check it out. So that concludes the webinar today. I want to thank everybody. And if we have some time here, go ahead and take some questions from the audience. Let's see here. Okay, so I had just mentioned this, but just to be clear, so we're getting a question here that says, if the companies like Uber can still raise so much in the private markets, why would they ever IPO? I mean, that's interesting. Travis Kalanick, the CEO of Uber, has actually said that they would stay private as long as possible. I mean, if they can raise this much money, then why would they IPO? So let's look at first what an IPO does, and let's see if, oftentimes these late stage rounds are what's called a private IPO. Um, that does, involve raising money for the company, which is good for growth. It also offers increased credibility and sustainability for the company, which is good as well. But what it doesn't do, like I mentioned earlier, is it doesn't always create liquidity for those early stage investors and those employees that may want to cash out. So companies have to weigh these things when they're thinking about IPOing. I hope that answers the question. Let's take another one here. This is good. Are we going to see more unicorn companies emerge from outside the US? Um, This is difficult to predict, but if you look at what we do know, two of the three most recent unicorns, like we said, are from China. I also know that recently, smaller countries around the world, such as the United Arab Emirates, have seen the emergence of some unicorn companies. So, in my opinion, yes, this is likely to happen. And the third question, okay, let's end with a bang here. How does Trump's presidency affect unicorns and the private market investment landscape around unicorn companies? So I'll start here by saying that uncertainty is the word of the day. We simply don't know for sure. However, and this is a big if Trump does get the billions of dollars that he's promising in corporate cash to get repatriated from overseas, we could see some of that money end up in the private markets for investing in unicorns, acquiring unicorns, or even in the public markets to buy shares in these companies. Time will tell. I think that's all the time we have today. I want to thank everyone for tuning in. If you had a question that didn't get answered, go ahead and shoot us an email or hit us up on Twitter, and we'll try to get back to you. Thanks.